Struggling with debits and credits? It feels like a foreign language because textbooks don't show you how it works in the real world. Today, we're ditching the theory. We'll follow a startup for one day and turn real business events into simple journal entries. By the end of this video, I promise the rules of accounting will finally click. Section 1. The Foundation, the Unbreakable Rules. The foundation of all accounting is one unbreakable rule. Assets equals liabilities plus equity. Think of it this way. Assets are what a business owns. Liabilities are what it owes. And equity is what's left over for the owners. This equation must always stay in balance. We keep it balanced using journal entries, where for every single transaction, the total debits must equal the total credits. But what do you debit and what do you credit? For that, we use my secret weapon mnemonic, dealer. Here's how it works. Dividends, expenses, and assets. These accounts increase with a debit. Liabilities, equity, and revenue. These accounts increase with a credit. That's the entire cheat sheet we need. Now let's get started. Welcome to our startup, Innovate Co. Section 2. A day in the life of Innovate Co. Transaction 1. The founder's investment. First, a business needs money. As the founder, I'm injecting $30,000 of my own savings into the new business bank account. The business's cash and asset goes up, and my ownership stake, equity, also goes up. Using our dealer rule, assets increase with a debit and equity increases with a credit. Debit, cash $30,000. Credit owner's capital $30,000. Transaction 2. Buying equipment on credit. Next, we need tech. We buy a new $5,000 computer and put it on the company credit card. Our equipment and asset increases, but we also took on a new debt, a liability. Applying the dealer rule, assets increase with a debit and liabilities increase with a credit. Debit, equipment $5,000. Credit, accounts payable $5,000. Transaction 3, our first sale. Our first customer. They buy a 1-year software license for $1,200 and pay us on the spot. Our cash is up and we earned revenue. Back to dealer. Cash is an asset, which increases with a debit. Revenue increases with a credit. Debit, cash $1,200. Credit, sales revenue $1,200. Transaction 4, paying a bill. Time to pay the rent. We send our landlord $2,000 for the month. We just incurred an expense, and our cash went down. Using dealer, expenses increase with a debit. Our asset cash decreased, so it must be a credit. Debit, rent expense $2,000. Cash, $2,000. Transaction 5, a sale on credit. We land another client and send them an invoice for $2,500, due in 30 days. We've earned the revenue, but we don't have the cash yet. We have a right to receive cash, an asset called accounts receivable. Dealer one last time. Assets go up with a debit, and revenue goes up with a credit. Debit, accounts receivable $2,500. Credit sales revenue 2,500. Section 3. The wrap-up and the aha moment. And just like that, the day's over. We handled investing, buying, selling, and paying bills, translating every event into a simple journal entry. Our guide was the dealer method. Assets, expenses, and dividends increase with a debit. Liabilities, equity, and revenue increase with a credit. By sticking to these rules, we ensured debits equaled credits, and our main equation, assets equals liabilities equity, stayed perfectly in balance. See? Accounting isn't some abstract puzzle. It's the logical story of a business. If this day in the life of Innovate Co finally made journal entries click for you, please hit that like button. It tells YouTube to show this to more people who are feeling stuck. And be sure to subscribe and ring the bell, because in our next video, we're going to use these exact entries to build our first financial statements. As a thank you, I've put a link in the description to a free, downloadable journal entry cheat sheet. Keep practicing, and I'll see you in the next one.